Okay, once again, good morning from Nigeria. Good morning to my AFM class students. Um, I'm sure you can see my screen now, and you can also see the slide I am projecting. Once that is true, can you please confirm?
Yes, I can see.
Okay, all right. Thank you.
Yes.
All right. One more thing. If you have, okay, just let's go through the content of today's class. Sorry, just a moment. All right. So we will start off with setting the context. Once again, my name is Shay. Please, anytime you have any question, just go ahead and let me know. I will let you know the process for that. And then I will run through an overview of the syllabus. Then we will look at a couple of questions and effectively wrap up. So please ensure that your mic is always on mute. I am usually very impatient with people who don't monitor their mic, and it may result in exiting the class and you may have to relog in. So please, 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 if you answer a question or you ask a question, once you are done, mute your mic. If you have a question you need to ask, just raise your hand. I can monitor that from my end and I will give you the floor. If you are also answering a question or asking a question or muting your mic, endeavor to ensure that your environment is not too noisy. Okay. So some background noise there. Be on time, especially after breaks. So it's likely that my first session now will run for 2 hours. We will have 15 minutes break and then we'll come back for the second section, which may run for another 2 hours, and then we would have lunch break, which is probably for 45 minutes, and then come back again for another, 1 hour, 30 minutes, 15 minutes break again, and then the final 1 hour, 30 minutes. So please be on time. Pay maximum attention as usual. As I normally say, don't blink, pay maximum attention. Don't let anything distract you for the next couple of hours. Participate as much as you can. If you've got questions, please ask. but, try to ensure that you are not asking avoidable questions. Questions like, how did you get this, when it was due to the fact that you were not, focusing on what we were doing, so that we can save time. Yes, so I wanted to appoint someone as our timekeeper, someone who will remind me that it's time to go on break. If not, there's a chance that we may keep going and I forget that it's time to break. So let me see. Is Shina here?
Yes, I'm here.
Okay, so please, 2 hours from now, which is effectively 11:15, just interrupt and let me know. Okay?
All right.
Thank you. True confession, Shay, I have not been reading and I've already paid for the exam, so I have to write it. What can I do within the next 2 weeks or so? Number one, you are in a very bad situation. I won't even lie about that. But there's still hope. Okay. So the hope is, one, pay maximum attention to what we're going to do today. Obviously, I want to do a quick review of the very important areas of syllabus. But that really will not contain a lot of teaching content. So it's really more like pointers. What are those things that you need to go back and, revise as you put on finishing touches? Then the other thing is questions. Yeah. So I'm going to show you an approach we decided to take in our standard class for revision, which was focusing on the past 11 diets, all the questions in the past 11 diets, and that really was about close to 40 questions. So 3 of them were for mock exams, which were submitted already. About 19 of them are to be done by myself in the classroom, of which I've done 18. So the one that is left, we will do it today. While the candidates were to do 15 other questions on their own. So the idea is, if you are able to go through 11 diets during your revision plan, you should at least have a fair coverage of how they can test different areas of the syllabus. So I hope the people knew about this before now are tracking in terms of their own area. But yeah, I mean, if you've not started reading and you have 2 weeks that you can put in your best, you can also try to do that, to have that same approach. If you can't do up to 11 exam sittings, you may reduce it to 9, you may reduce it to 10, or yeah. Then after that, you need to do mock exams. So I'll talk more about that on my subsequent slide. All right, so let's get to it. As you know, the paper rather, has 5 sections of the syllabus with 4 core areas. And the 4 core areas are AIA, okay, M&A, CRR, and CARM, Treasury and Advanced Risk Management. Those areas will be the focus of my review. But obviously, there's also a section of the syllabus that says candidates should be able to understand the role senior financial advisors play in multinational organizations. And obviously, that cuts across each one of those 4 areas, for example, in addition to the background that the syllabus provides. So I expect you to cover that on your own, but not at the expense of, these 4 critical areas. So the examining theme, okay, no, not yet. So you've got 3 hours, 15 minutes to do the exams. As you know, it's computer-based. So there's a transition into computer-based exams. By now, I'm sure you've already started practicing on test reach. Okay, I will talk more about that on my subsequent slides. So you have question 1, which is 50 marks, and 2 25 marks questions, which is also mandatory. Now, obviously, one key question is, should I start with question 1 or should I start with, section B? To be honest, I think you should decide your own strategy, because those are the kind of things you get to decide if you are, putting yourself under exam condition. A candidate may see a section B question that is on interest rate risk management and say, someone is not muted, please, and say that I am pretty much comfortable with interest rate risk management, so I think I will prefer to get that out of the way. So you may start with a section B 25 marks question, come back to question 1, and then come back to the last 25. Alternatively, if question 1 is reasonable, you can start with that. I think the more important thing is to stick to time, and why I sometimes say you can start with an easier question in section B is that it's more manageable. So you get to know that you've got, is it 45 minutes to take care of that. And if it's an area that is your strength, then you can actually leverage that strength. In order to avoid distracting me, please check your mic and mute your mic if you are not on mute. Someone's noise that is filtering in. I'm hoping I can see the person, so that will be our first. All right, so all questions are compulsory. Now, here is the big one. One major reason why students have a problem with this paper is that they often think it's more of calculation than narrative. Okay, and remember, we've proved it over and over and over and over again that your question 1 will typically be 55 to 60% narrative, not calculation. And what's that? 40 to 45% computational, so calculation, computation. Okay, so that's for question 1. Now, question 2 may tend to take a reversal. So it's likely that you may see, 60% to 55% as calculation for section B, while, 40 to 45 discursive. But that of question 1, it's almost like, you'd have to do more with writing. So overall, you can then say that this paper is almost 50-50 in terms of both elements. Okay, so do not, have two, weighted mindsets around the computations without being able to explain what you have done and being able to communicate the implications of what the results tell you. All topics and syllabus sections will be examined in either section A or section B, but every exam will have questions which have a focus on syllabus section B and E. So let's go back again and ask ourselves, what syllabus section is B and E? So the examiner, that statement I just read now is by the examiner. The examiner said every diet. If you don't see section B and section E in your exams, leave the exam hall and go to court. Okay, so there will be questions on investment appraisal. I normally say that's the biggest side of the syllabus. And there will be questions on hedging, whether currency, interest rates, or, treasury function generally. What does the examining team say are the common mistakes why people fail the paper? One, lack of detailed knowledge of parts of the syllabus. Obviously, I mean, everything starts with having the right knowledge and understanding of the syllabus, okay? So perhaps that's one of the reasons why I'm going to be pointing your attention towards the very important areas of syllabus today. Poor time management, very true. Most candidates say that, sorry, not most, a lot of candidates say that they begin section B once they hear 1 hour more. Okay. Well, I think they used to announce 1 hour more for paper-based exams. I'm not sure if that will still be the case in a CBE environment. So maybe there's some timer somewhere that you'll be looking at. So, but obviously, for someone to fall into this kind of trap, it's poor time management. So, and how do the examining teams know? You're wondering, oh, this guy marking my script was not in the exam, or the typical way they know is that they see that you are stopping in the middle of a question. Okay, so you are taking your last question, for example, and you've only answered the A part, which is 5 marks. So there's an additional 20 marks that have not been touched. Okay, or they see that you pick bits and pieces here, and maybe you're writing a sentence and somewhere in between the sentence is not complete, and that's the end. So they can fairly tell that what this person had as an issue in the exam was time management. Not responding directly to the question requirement. I think this is a general problem with ACCA papers. Examiners often say that candidates sometimes set their own questions, okay? So the examiner has said, state the assumptions that you made in your evaluation in A above and discuss the other factors that should be considered in determining whether to go ahead with the project. In addition, reflect on the statement by the non-executive director. So there are 3 things in what I've just said: the assumption, the other considerations, the statement by the non-executive director that they want you to evaluate. So you have to be careful to ensure that you understand the requirement verb. Is it evaluate? Is it discuss? Is it explain? Okay. And you have to be sure that you track every component of a requirement. So if there are 3 things they've asked you to do in 1 sentence requirement, you have to be sure that you covered those 3 things. Poor structure to the numerical and written answers. Yes, I've sometimes tried to mark what's the name, paper-based exams, mock exams that students do, and I can understand where the examiner says sometimes we struggle to put the numbers together and make sense of what the students have written from a presentation perspective, okay? So that's why a CBA exam is probably more reasonable. I remember during one of our webinars on how to use the platform, someone asked, can I just dump all my answers on the spreadsheet, that I would have provided on the platform? And I explained that while that is possible, it's not a professional thing to do. Okay, so use your spreadsheet to do your calculations. Pretty much will be your appendix. And when it's time to prepare your report, go to the word processor, put down your report, and make reference to the spreadsheet, where you have your computations that have been done. Okay, so it's very important that you write logically, clearly, even if what I'm saying is wrong, but let the examiner understand that wrong thing that I've written down. And if it's right, yes, then it makes things a whole lot better. Excessive use of bullet points instead of discussion. So as I said, the three very popular requirement verbs are often discuss, explain, and evaluate. Certainly, these requirements don't don't fit into bullet points, right? So the examining team is saying here that students use too many bullet points, and that will reduce the mark allotted to them. Not taking into account marks available when answering written questions. Exactly. So what I've also noticed is, so when we are solving a question and it's time for the written part, and I say, okay, oh yeah, let's discuss. What are your views? You have this very silent classroom sometimes. Well, I think it improved towards the revision time. Yeah, but sometimes you have this very silent classroom. Nobody wants to talk because we have just finished calculating MPV or doing all the complex things. But then what they are saying here is sometimes we allocate a lot of marks to the discursive part, and people just give surface answers, answers that lack depth. So it's important that you read the requirements, that is narrative, and you plan your answers. So they've put 8 marks here, or they've put 12 marks here. So what do I say? How many things do I have to say to earn these marks? You have to plan your answers and force yourself to think through it. Not taking a balanced approach. So taking a balanced approach means a lot of things. So whether it's in terms of your question selection or spending time on a question that you're not really comfortable with, when there are others that you are very familiar with. So you want to ensure that when they say stop writing, you are not giving them free marks. Now, still on the examining team, what they say, in fact, they write it clearly that there are 3 important reasons why you should sit a mock exam. 1, sitting mock exams under exam condition is essential preparation. 2, to pass AFM, you need to be able to apply knowledge in a way that is appropriate to the situation faced. And that addresses the question requirements. And 3, mock exam provides an opportunity to learn from your mistake and to receive feedback on your approach. So please, if you did not submit our last mock exams, make sure you do at least 2. In fact, the minimum should be 3 for this paper. Okay, at least 3 on your own, and you mark it. Now, some of you may say, oh, we've practically solved all the questions that are available. No problem. I can give you questions that are before, 2015, which was, when our cycle started. So you can use those ones as your mock exams. More important thing is put yourself under that 3-hour, 15 minutes practice, and don't do that without using the CBE platform. So on the CBE platform, you already have what's the name? Questions, for example, some of these diets that are assigned. So I think we use June 2019 as our mock exam. So you can go to TestReach, assign questions to yourself and practice it so that you get a very thorough feel of how it's going to be on exam day. We have a lot of things going on this slide. Not sure if you can see it clearly, but I think you should. So when I send the slide to you, you can pretty much go through the detail. I will just highlight a few things that I think is important, on the slide. So if you look at the second column, it says tips for success in the AFM exam. Break down requirements into constituent parts. You remember I've already talked about this, into constituent parts. So a requirement can have, different areas. Understand what matters to business and the viewpoints of stakeholders who are interested in the subsequent decision based on the discussions and evaluation asked for. Use information provided in the scenario. This is also very important. I see. Joy, go ahead. What's your question? Shino, go ahead.
Sorry, I'm not seeing the slide you're showing. It's not changing. It's still on the importance of mock exams here.
Oh, okay. Maya, is that the same thing you wanted to say? Just a moment then. Just let me see. All right, should have changed now. Can you see it now?
Yes, please. Yes.
Okay. So use information provided in the scenario. Of course, you've got to, apply your broader knowledge, but always ensure you don't talk outside the confines of the scenario. Extremely important. Communicate findings and recommendations clearly, concisely, with easy to follow numerical workings. You see the emphasis. So it's not Shay that designed this PDF. You can even see ACCA logo here. So they continue to emphasize this easy to follow numerical workings, very, very important. You should present your answers in ways that someone marking your scripts can easily follow. And, get the professional marks, whether it relates to presentation of your answers, logical flow of your comments, and things like that. Very important. Advice from the examining team. Support your studies with wider reading. Maybe that's too late for now. I don't know. Be aware that more than one topic area of the syllabus may be examined in a question, particularly question 1. Relate any discussion or evaluation to the scenario in the question. Context is very important. That's what they say. Context is very important. So manage your time properly. Structure your answers properly. Presentation is critical. This paper is pitched at the level of a senior finance advisor in an organization. So you've got to be able to communicate your findings in very clear, concise, and logical terms to senior management and to the board. Most frequently used verbs: discuss, estimate, and evaluate. So estimate there can sometimes be calculate, okay? So that's the computational part. But then once you see discuss, evaluate, or assess, those probably will be the discursive elements. So question 1 will include 4 professional marks, typically for a report. How will you get that 4 marks? Use an appropriate format. So if the examiner had said briefing notes or report to the board, use the appropriate format. Plan a logical structure. If you want to talk about assumptions, let's know you are talking about assumptions. If you want to talk about the result of the WAC competition that you have done, let's know that that's what you want to talk about, okay? Use sub-headings and headings within your report. Very important, so that, we are able to clearly identify them, write clearly and concisely. So you've got here resources that can help you. There's actually an article on how to earn professional marks. So you can also consider going through that, but certainly you should go through examiner's report, which is the final one on the slide. All right, so before I start with syllabus review, is there any question? Please please, if you are joining us for the first time today, feel free to ask questions, okay? If you have any question, just raise your hand. You are part of the family, okay? So please feel free to ask questions if you have questions. All right, so Brand, yes, go ahead. And if I murder your name, please forgive me. Go ahead, Brand. You are muted. I can't hear you. All right, looks like he's not ready. You can. Hello, yeah? We still can't hear you. I hope it's not from my hand. Okay, so maybe you can fix your connection and try again. All right, so what we have here is the study guide. The study guide. When I was writing ACCA, how did I use the study guide? 1 week to the exam, I will download the syllabus, okay, like raw syllabus with the requirements. And then I will start reading, you know, all what they have under it. So discounted cash flows, for example, if it says understand how to identify relevant and irrelevant cash flows, I'll ask myself, do I know how to identify relevant and irrelevant cash flows? If I'm happy with that, I will tick it. Be able to project forward rates from spot rates. If I don't know how to project forward rate from spot rates, I will cancel that area. Now, every area that I cancel takes me back to my textbook because I'm doing that as part of my revision, right? Oh, okay, so this is how to project forward rate from spot rates. Okay, so now I know it. So that's how I use the syllabus. This one is study guide, though. This is not, syllabus is a more detailed breakdown of the study guide. So starting off with section B, as I said, my focus will be on B to E. Section B of the syllabus says you need to know 5 things. Okay, you need to know 5 things. Number 1, discounted cash flow techniques. Now, what does that mean? And what do you have in there? We will see that shortly. Number 2, you need to know how to apply option pricing theory in investment decisions, right? So option pricing here talks to 2 sides. One are financial options. For example, they could ask you to value share options. And the second one are real options. So they could ask you to value options that are embedded in tangible projects. Okay, so either financial options as part of making investments decisions or real options. 3, impact of financing on investment decisions and APV. This is you see this number 3, a lot of students are not very comfortable with AFM or do not have a good grasp of certain areas of the syllabus because of this number 3. Because this space is saying, what impact does your financing structure, strategy, or model have on the investment decisions that you make? And obviously, you know that what financing ends up with is often cost, which is your discount rate. So the whole idea around discounted cash flows is to bring 2 things together. Your discount rates, which this addresses, and your cash flows. That's what it's bringing together, your discount rate and your cash flows. So how do I calculate WACC? How do I calculate cost of debt using yields to maturity or spot yields? How do I price bonds? How does the price of a bond change as interest rates changes? What impact does credit rating have on these processes? These are questions that you need to be able to answer. How do I adjust for risk in projects in my discount rate, whether it changes in business risk, changes in financial risk. That's what this section deals with. Number 4, valuation and use of free cash flow. Now, to be honest, I really don't know why ACCA decided to put this number 4 here, because I think it is actually more useful here and here. But the truth is, mergers and acquisition is also an investment decision. Okay, a decision to restructure your business could involve, unbundling businesses, reorganizing how your businesses are structured. And so you may have to do valuations. So the concept of free cash flow to firm, I will normally introduce it under mergers and acquisition. And then finally, international projects. So when you are talking about this number 1, discounted cash flow, it can be both from the context of a local project or an international project. That international project is what number 5 is dealing with. All right, so let's get to advanced investment appraisal. So what are the things that I need to know here? I think the first thing is to understand the big picture of that topic. As I normally say, that's a very important area of the syllabus. In fact, it sets the context for a couple of other areas within the syllabus. So let me put it this way. So you have here advanced investment appraisal. Pretty much covering 2 things. The investment phase, which really are the cash flows of the investments. Okay, so I'll call that the investments. And then the other is the discount rate or the cost of fund, which you can call the financing, right? Now, these investments can either be a local investment, right, or an international investment or foreign investment. You need to at least understand how to build your cash flows for a local project before you can then start extending that to an international project. So whether it's a local project or an international project, you will typically need to deal with identifying your relevant cash flows. Okay? And the ultimate objective is to get to a destination. So the destination in terms of building your cash flow is something I call net cash flows. Net cash flows. Net cash flows. Okay? So your net cash flow would have started from revenue, and so let's quickly okay, so I think I'll take care of that on my next one. Now, on the other side, which is the discounting side, you have to make decisions, various decisions. These are things the syllabus covers, right? Should I use my current work to discount the project? Or should it be a project-specific work? Can somebody remind me, what trigger will you see in the question that will make you know that you have to calculate a project-specific work? What triggers will you see in the question that will make you know you have to calculate project-specific work? Wow, you guys are super responsive. Moye, go ahead.
Okay, when you see that the company is, hi, good morning, everybody. When you see that the company is either leaving their sector and trying to have a project in another sector.
Okay, very good. So the company is doing a project in another sector, which may imply that the business risk is different. Okay, Emmanuel.
Okay. There is a need to change the to calculate a new one where there is a significant change in capital structure.
Very good. So where you see, for example, that the funding structure that will be used for the project is significantly different from the current capital structure of the company. And you probably believe that this is a significant project. So effectively implementing that funding structure will change the capital structure of the organization. All right, that's very good. Thank you. So those are the two typical things that the question will tell you that will make you know that I don't think I can use the current work. Number two, you will then have to, your discount rate will be driven by the appraisal method that you are using. The appraisal method that you are using. So for example, while you may use WACC if using NPV, you can never use WACC if using APV. For APV, you will have to use what? Your all equity rate for the operating cash flows of the project and your cost of debt or risk-free rate for the financing side cash flows. So the rate you will use will depend on the appraisal method that you're using. Also, your discount rate will be influenced by your financing source and the issues related to that. So as a candidate, you must be able to discuss what are those characteristics that a debt instrument would have that will make it different from an equity instrument or compared to a convertible instrument. You know, sometimes they may bring in salient questions around basic Islamic finance, but it's not expected to be, a significant part. So this basic knowledge is really what you've carried forward from financial management to this paper. Okay, now you should be able to understand the cost of debt side of things. So bond prices versus yields, what relationship exists. And obviously, one way to study that relationship is through computing duration. So, and then finally, capital structure theories will help you explain. Remember, the idea behind capital structure theories is, can an entity reduce its cost of capital by changing its capital structure? So we have the traditional view, we have the Modigliani and Miller, we have all those things. No examiner will typically ask you to explain pecking order theory or explain Modigliani and Miller proposition 2. But they may give you a question that will require you to use some of those models and framework to explain your viewpoint. And that's why it's important you know them. Now, is this all for investment appraisal? Certainly not. Now, two things then impact these cash flows and discount rates. Number one is BSOP models. What's BSOP? Black-Scholes option pricing. One of the limitations of a traditional NPV or APV is that it fails to consider options that are embedded in projects. For example, option to expand gradually, option to delay commencement until an uncertainty is cleared, or option to abandon if you see that this thing is not progressing as expected. Black-Scholes option pricing model helps you to value such options. Then you may also have to consider the impact of risk and uncertainties in your project. So this is pretty much the big picture of advanced investment appraisal. So when I say here that it is driven by the method, you need to remember that your syllabus requires you to know 4 methods of investment appraisal. 1 is MPV method, 2 is APV method, 3 is IRR, and 4 is MIRR. The discount rate you use here is either the current WACC or the project-specific WACC. The discount rate you use here is the KE ungeared, which we also call the all-equity rate, KE ungeared, cost of equity ungeared, and KD for the financing side. The discount rate for IRR is the answer to it. So that's actually what you are looking for, the break-even rate. The break-even rate. So that is determined. You have to determine that one. If the examiner wants you to calculate IRR, then you have to be the one to determine it. And same thing for this as well, MIRR, just that this comes with a more break-even rate with a more realistic what? Reinvestment assumption. Reinvestment assumption. All right, so let's take it out one by one. If there is no question, I don't think there is. Yeah, so first thing here says cash flows, local projects. So always remember that at the end of the day, you want to get to a destination, and that destination is your net cash flows. So typically, you start off by building your revenue projections. You take out the operating expenses. You take out tax allowable depreciation. That gives you your taxable profits. You deduct tax following the assumption given to you by the examiner. That gives you your post-tax cash flows. You add back TAD. As I've said, I don't like using the tax savings approach. You bring in non-operating cash flows. So what you have here are operating cash flows. Relevant operating cash flows, right? Or here, non-operating cash flows such as initial outlay, right? Scrap value or realizable value, working capital investments, all those things. And when you are dealing with your cash flows, you may also have to adjust for inflation, right? And then this gives you, when you put all this together, it gives you your net cash flows. Net cash flows. Now, it's also important to remember that your net cash flows for a local project stops there, and you have to proceed to get your discount rates. Okay, so obviously the next direction can then be, am I using IRR? Am I trying to get IRR, MPV, APV, or what? MIRR. Okay, so if it's IRR, now that you have your cash flows, you know what you have to do. You discount using lower rate, you discount using higher rates, and then you interpolate. If it's MPV, you discount using WACC. If it's APV, you discount using all equity rates. If it's MIRR, you apply the MIRR formula, which I also think is on your formula sheet. So obviously, as I've said here, take care of what? Inflation, if there is. For example, if they're telling you something is in current price terms, take care of the fact that you need to grow it to reflect the impact of inflation. Take care of real growth. So cash flows may grow because of inflation. Cash flows may also grow in real terms. Okay, so you also need to take care of that. Take care of your tax assumption. So are we paying taxes, in the current year when the cash flows are made, which is usually the assumption, unless the examiner specifically tells you tax will be paid with 1 year delay, which means you will have to, take it to the subsequent period. If you are dealing with an international project, then obviously there will be some additional things that you will need to take care of. Please remember the cash flows that you must identify are relevant cash flows. Relevant cash flows and relevant cash flows only. So if I'm dealing with an international project, what will my cash flow projection look like? Remember, we are talking about cash flows. And remember, I started by telling you discounted cash flow is really about two things, your discount rate and your cash flow. So we are still focusing on cash flows, okay? So again, revenue. Next, operating expenses. Next, CAD. That gives us what? Taxable cash flows. Next, tax. Next, post-tax cash flows. Next, add back TAD. Next, non-operating cash flows like outlay. It's kind of funny that sometimes when you are looking at candidate scripts, you see some people starting with initial outlay. They put their working capital and they put revenue, they put cash flow, everything. And then they now apply taxes on all those cash flows. You don't tax working capital changes. You don't tax initial outlay on all those things. In fact, why we bring in working capital changes is to change that our revenue to a cash-based revenue and all our expenses to cash-based. Okay, so, or put simply, these are additional investments, you have to invest or make to continue to ensure that you can sell and you can buy. So anyway, let's not go into those details. If you remember why we do working capital changes in cash flow statements in financial reporting, the main reason is because the POL figure you are picking, which is your profit before interest and tax, whatever you're starting with, are accrual based. So you do your changes in working capital, whether increase in inventory, decrease in payables and all of that, so that you can adjust that accrual-based revenue and expenses to make them equivalent to their cash flow impact. So that's why we just normally bring in changes in working capital, but it has to be, after the tax impact. All right. Yeah, non-operating cash flows. And then what does this give you? Net cash flows. Now you will see that all these are similar to the local project I explained earlier. But what do you need to remember? Number one, these are all in foreign currency. They are all in foreign currency. That is, in the currency of the country where you have invested. Then next, what happens? Translation converts to local currency. So here you may have to predict exchange rates. You may have to predict exchange rates. And the examiner typically uses inflation method, which is the purchasing power parity model, to predict exchange rates. It could also be the interest rate parity model, but most times it's the inflation based one. And what's the formula for that? Your forward rate equals spot rates. So if your spot rate is dollar, so let's say this is dollar to pounds. So spot rate times 1 plus inflation rate 1 plus inflation rate. So the question is, which inflation rate will be on top? The inflation rate that will be on top is the reference currency. So here is dollars. The inflation rate that will be beneath is the base currency, the one expressed in 1 unit. And in this case, that would be pounds. Okay? So you predict exchange rates using that formula. Now, if there are remittance restrictions, you also have to take care of it. Okay, so here as well, you need to consider remittance restrictions. So the question may tell you that the company can only remit back home 80% of its net cash flows. Or the question may even also tell you that withholding tax apply. Withholding tax may apply. So if withholding tax applies, you need to apply withholding tax rate on any amount you want to remit back home. You see that? So a lot of things may be going on there, but typically the more popular one is just for you to deal with the exchange rates. Once you've converted, what you now have is net cash flows remitted. Very important, it may not be the same as what you have above in local currency, LCY. Net cash flows remitted. Okay, Moya, you have a question. Go ahead.
Thank you, Shay. So I have a question. I was looking through a past question. I think it was the recent mock, and the question said all cash flows have been properly inflated, and still went on to put revenue should be inflated by this, and fixed cost should be inflated by this, variable, like it still went on to put specific inflation in the question after saying all cash flows have been inflated as appropriate. So my question now is, do you still have to inflate the cash flows that they said they have already inflated, or is that just a throw-off? How do you treat
so
it?
there's already a conflict in what you've said, and I'm not sure that's the intention of the examiner. examiner will not give you cash flows for future years. You build cash flows, right? So best they will give you is what the cash flow is historically or as at now, and then you use that to build. Or they will tell you year one revenue will be this, and this is expected to grow at this rate. Do you understand? So your normal thing you do in discounted cash flow is you build the cash flows based on information given to you. So there will be nothing like all cash flows have been inflated because you are the one building the cash flows. So if you're starting from year one and they give you specific inflation rates, you have to obviously reflect those inflation rates. I don't know if I answered your question.
Not really, but I understand what you're saying.
Except I see what you're saying. Except the examiner tells you, so let me give you an example. Examiner tells you fixed cost for year one, year two, year three, and year four will be this amount, this amount, this amount, this amount, and they are already inflated. That one you don't reflect inflation. But if they tell you, fixed cost for year one will be this, and is expected to grow at this rate, and somewhere they now say cash flows have been inflated, that's already a conflict. Except I see the question, I really do understand, what that is about. Bilkis, go ahead.
I just want you to shed more light on the difference between, cash flows in real terms and in current terms. That's one. I don't know if you got that.
Although your voice is very low, you need to speak up or move closer to your mic.
I said I want you to help shed more light to cash flows being and in current terms. The difference between them. That's
Okay.
one. Then the other question is on withholding tax. You said earlier that withholding tax should be on the cash that is sent back home. Now, there's a question I solved recently, and it says they gave us the question says they want to take back dividends home, and like they want to repatriate, send dividend back to their parent company in another country. So they now also give us withholding tax. So then I applied the withholding tax on the dividend, but in their own solution they didn't put it. I just wanted to help explain that too.
No, so if there's let me take that second one first. If there's withholding tax and they tell you that it would apply to any dividend they are remitting, you have to apply the withholding tax to the dividend. So it should be what they will remit will be net of withholding tax. But if there is no withholding tax, then there is no withholding tax. The entire amount is remitted. So I don't know what you saw in the question and how they eventually treated it, but withholding tax is not complex. Yeah.
Do we normally apply withholding tax to dividend, or is it just the cash flows that is sent back home?
Okay, so wait. A company has an international project. It made 100 naira. The company decided that they want to pay the 100 naira back home, right? And they say withholding tax of X applies. You apply the withholding tax on the 100 naira. But if the company say out of this 100 naira, what I want to pay back home is 80 naira, then you only apply the withholding tax on the 80 naira to the extent that the withholding tax applies in the question. Okay. You said I should, yeah. You said I should explain the difference between cash flows in current price terms and in real terms. Is that what you said? All right. So cash flow in current price terms means the same thing as cash flows in real terms. Okay. So current price terms means as at now. Okay. So if an examiner says you will pay for advertisement over the next 4 years, starting in year 2, over 4 years, starting in year 2. And they tell you your first amount that you pay in year 2 is 5 million in current price terms. Okay, or in real terms. What they are telling you is the inflation that will happen from now to year 1 and from year 1 to year 2 have not yet built it into this amount that I've given to you. What I've given to you is based on price levels as at now. So before you put that your first advertisement cost under year 2, inflate it for 2 years. So a cash flow given to you in real terms or in current price terms, they mean the same thing. A cash flow given to you in nominal terms means it has reflected the impact of expected inflation. I hope I answered your question. Yetunde, go ahead.
Okay, thank you. Can you just quickly explain the purchasing power parity? It confuses me sometimes to know the inflation rate that has to be on top or beneath.
Okay, that's what I said here. So let's use an example. So if, for example, the spot rate between the dollar and the pound is $1.2, right? That means the pounds is the base currency, while dollars is the price currency or reference currency. Okay, so what I said is depending on how the spot rate is expressed, okay, the rate that will be on top for your inflation rate will be the inflation rate for the price currency, while the rate that will be beneath will be the inflation rate for the base currency, which is the one expressed in 1 unit. I hope you're fine with that.
Yes, yes. Thank you.
Now go ahead.
Thank you, sir. I was thinking that maybe along the line you go with asking questions. Let me ask my question. Rate, the idea behind cross rate, particularly those one expressing spread.
Sorry, Shido, your network is not good.
Hello, hear me clearly now?
I can hear you, but it's breaking. Go ahead. Let's try again.
I'm talking about cross rate, arriving at cross rate, especially
okay.
for those one expressing a spread.
Yeah. Yeah. So yeah, what's the question?
Like how to calculate this cross rate, especially when the rate are in a spread.
Okay, good question. I think I have a fair idea of your question, but I don't want you to take me out of my comfort zone right now. So when we get to currencies, okay, remind me and I will explain that to you. But I know what you're saying. Any other? If you've asked your question, you can drop your hand. All right, so let me move on. Net cash flows remitted in local currency. Then the next thing is to deal with home country cash flows. Home country cash flows, right? Home country cash flows. So home country cash flows could include things like additional tax. So if, for example, the tax rate at home is more than the tax rate abroad, then you may have to pay additional tax at home. Okay, and that also depends, and also how you do that depends on whether there's a double taxation treaty or not. Next, home country could also be opportunity cost or lost profits because you are now, investing internationally. Okay, or it could be, profit you make from selling goods to the company abroad. Yes, so once you've taken care of home country cash flows, then what you now have which obviously will also be in local currency, right? So what you now have should be the overall net cash flows of the project in local currency. Okay, please always remember your additional tax is on the taxable profits that you made abroad. So additional tax, if you track this line that I'm drawing, is on the taxable cash flows that you made abroad. So obviously your exchange rates would also have to come in. Now, I have a question. Can you tell me 3 examples of measures an entity can put in place to circumvent remittance restrictions? 3 examples of measures an entity can put in place to circumvent remittance restrictions. Osaranwe said, go ahead. Osas, go ahead.
Transfer pricing.
Yeah.
Management fee.
Yeah.
And
I didn't hear the third one. Okay, so she said transfer pricing. So you can transfer goods to the foreign country at much higher prices to repatriate certain amounts. You can charge management fees. For example, if you have members of your team that is providing services to them, you can charge higher rates. One more, Emmanuel.
We could say royalties.
Okay, royalties. So for example, if they are producing your product, you could charge them, for every unit they produce. Or even you could give them loans to finance their operation, and those loans could be at higher rates. All right, good, good, good. So I think I'm good with that. I move on to my next slide, which now I want to focus on the financing side. The financing side. Now, you know that your weighted average cost of capital is extremely important. Samuel, your hand is up. Do you have a question? Osas, can you drop your hand if you don't have a question?
Yeah, hi Shay.
Yeah.
Thank you. I just wanted to add, or because I just observed that these measures we just mentioned now, can we also say that all these are subject to the transfer pricing policy of the local currency, if there is any?
Yeah.
Because I mean, if they have a transfer pricing policy, you can't just charge any high
as you
price
wish.
on. Yeah, exactly.
Yeah.
Yeah.
Yeah, that's correct. That's why most jurisdictions now have their own transfer pricing regulations, and what we normally say is you would have to assume that for tax purposes, fair values would apply rather than your own artificially inflated values. Do you understand? Yeah. So if such exists, that's fine. Now, but I've really not seen the examiner stretch candidates to this extent. But let me just tell you something, just for the sake of saying it, so that you can have a picture of what we are talking about. If my US subsidiary is buying study notes from Ivy League Nigeria, and each study note should actually be worth $100, but we are telling them to pay $150, and they are actually paying $150. Now, for tax purposes, okay, only $100 would apply. for your cash flow projection purposes, which is your operating expense, which is a cost to the US subsidiary, the actual amount paid, which is $150, would apply. So that may mean that for you to compute taxes, you will have to do a separate workings where you will bring in the fair values rather than the inflated values. Okay, but as I said, I've really not seen, an actual AFF pass question where they wanted you to start dealing with transfer pricing issues. All right, let's move to work quickly. Yeah, so remember that work is important because it sets the minimum return required by who? Debt and equity holders. Debt holders and equity holders. So that's really why it's important. So obviously, it then becomes our minimum return that a project must generate for we to accept that project. Now, remember, in terms of measuring work, you would have to get your cost of equity, you would have to get your cost of debt, you would have to get the weights. Okay, the cost of equity, we calculate that using either the dividend discount model or the capital asset pricing model. The dividend discount model for calculating cost of equity varies with assumptions that you are making about growth rates. There's a scenario where there will be no growth, so you have to know what the formula will be if there is no expected growth in dividend. And there's a scenario where there will be constant growth in dividend. So you also have to know what your formula should look like where there is a constant growth in dividend. The capital asset pricing model remains what it is, risk-free rate plus market return minus risk-free rate times equity beta. Now, cost of debt is effectively the after-tax yield on the debt instrument. And typically, we calculate that using IRR. Now, one of the things you would have to be careful with is that you don't mix up, spot yields, yields to maturity, and all of that. You don't use spot yields for your cost of debt. You use the yields to maturity on an after-tax basis because you have to reflect tax rates. The weights that you would have to use will mean that you have to calculate market values of equity and market values of what? Debt. And where there is no information to calculate market values, then obviously you use book values. One indication that you need to calculate market value of debt is where the coupon is not equals to the yield. The moment you see that they are telling you the yield on a bond is 10%, the coupon is 12%, then the book value can never be the market value. It's an indication that you have to calculate the market value. Obviously, I do not intend to go into the details of how to compute work during a revision class, so I'll just skip that, but it's a very important stuff. Next, still on discount rates or work, we are aware that there are situations where you may have to calculate project-specific work, where there's a business risk that is changing, or is different. Financial risk is different, and then the project is large. Okay, the project is large. That is, the project is material enough to affect the overall business risk and financial risk of the entity. Next, you will have to adjust for changes in business risk. So the first one is adjusting for changes in business risk. How many steps? 3 steps. You look for proxy equity beta, ungear the proxy equity beta. When you ungear, that gives you what? Beta assets. Then you regear that beta assets using project's capital structure. Project's capital structure. Okay. So once you have the and that gives you better equity for the project, and that's what you then use in CAPM to get the KE for the project. Now remember that this second step has to be using proxies, the proxy entities capital structure. But if you are adjusting for changes in financial risk, that's 2 steps. Ungear, current better equity, and that gives you better assets. And second step is what? Regear, better assets using the revised or proposed capital structure. So obviously the first one there you would have ungeared using the current capital structure. Ungear current, this is current be using current capital structure. Okay, so that's in terms of it's either you're adjusting for business risk or adjusting for financial risk. Okay, and obviously once you get your beta equity revised, that then feeds into CAPM and KE. Now, here, pay attention. Very important points here. Bond yields, credit spread, and all those things. Now, what are the key things that you need to know here? I guess the first thing you need to know is role of credit rating. So credit rating parameters, there have been several past questions where they will ask candidates to tell the examiner what are those parameters that rating agencies typically consider in rating an entity. Okay, so things like management quality, industry position, industry risk, financial flexibility, gearing, all those things. You should be able to explain them. Okay, then 2, you should be able to pick spot yields from a credit rating table. Those are the two fundamental things you must be able to do. Okay? Be able to explain the credit rating criteria and be able to select spot yields from credit rating table. And remember, when you are selecting spot yields, or when we talk about yield, your yield is the annual return, annual total return on a debt instrument. And we've said that yields can be presented to you in the exams in one of two ways. One, as spot yields. And you know what spot yields are? Spot yields are the rates that would apply to each of the cash flows of the debt instrument for each year. So typically a debt instrument may have cash flows, which are the coupon and then the principal at maturity. So spot yields are the yields that apply on each of those cash flows for their respective years. So typically spot yields would differ for year 1 to year 2 to year 3 and all of that. But know the limitations of spot yield. The main one being that it is difficult to communicate, even though it is what we use to price bonds. The other way yields may be presented to you is as yield to maturity. Yield to maturity is effectively the process of standardizing spot yields to convert it into a constant rate. So that's why I will say constant rate. That's really the idea. So the idea being, if I already have the price, so bond valuation, spot yield helps you to value a bond. So if I already have the bond value or the price, I have the cash flows, I have the time to maturity, I have the redemption value, then I can calculate my yields to maturity as IRR without tax. Very important, because I'm talking about yields here, not cost of debt, without tax. Now, typically, yields, whether it's spot yield or yield to maturity, will often be a consolidation of two things. Yield on risk-free rates, risk-free securities, risk-free debts, plus credit spread. Plus credit spread. Yield on risk-free securities plus credit spread. Next, what do you need to know? You need to understand the relationship between coupon and yield. In this case, yield to maturity, because your coupon is usually a constant rate, right? Okay, so typically we say if the coupon and the yield are the same thing, then the bond is at par. If the coupon is greater than the yield, then the bond is trading at what? The discount. So coupon equals yield, then you have par. Coupon greater than yield, then you have bond trading at premium. This thing, sometimes you can use it to check the reasonableness of your answers. Coupon less than yield, then the bond should be at a discount to the par value. Then you should remember that there is an inverse relationship between yield versus price. And what helps you to study that relationship? You must know how to calculate Macaulay duration and modified duration. So can somebody at this point tell me the difference between Macaulay duration and modified duration? What's the difference between Macaulay duration and modified duration? Yes, Donny, go ahead.
Break time.
Which one is break time? Is break
You said
time
10:15 now. Yes,
not me. I said 11:15.
so you said 10:15.
It's not even 10:15.
Yeah, it's past that. I thought it was 10:15. Okay,
And
no
that
worries.
assignment is not
What
for
world
Shino.
are you talking
The
about?
assignment is for
And you are
Shino.
not the timekeeper.
Well, I thought the timekeeper had forgotten. That's
It's
fine.
11:15. It's 11.
It is not 11:15 yet.
Thank you,
Okay.
timekeeper. At the time
I
when
stand
Duni is supposed to
corrected,
answer
though.
my question, she's telling me it's time for break.
Okay.
Chineye, go ahead. Chineye, you're on mute. Okay. Bilkis, go ahead. Looks like Chineye.
Hello? Hello? Can you hear me?
Yes.
Yeah, Macaulay duration measure is the approximate number of years it takes to recover the benefits from a bond. While
And what are the
modified,
benefits of a bond?
the benefits of a bond include those are the inflows. That's the redemption value and the coupon payments.
Yeah. So it is the number of years it takes to recover the cash flows of a bond. Don't make the mistake, everyone, of saying Macaulay duration tells you how long it takes to pay back your investment in the bond. No, it does not show us how long it takes to pay back your investment in the bond. It just tells us how long it takes to recover the cash flows of the bond, which is the coupon and the redemption value on a present value basis. Okay. So what about modified duration? Yeah, go
Modified
ahead.
duration. Modified duration tells us the percentage change in the bond price as a result of a 1% change in the yield. So it
Very
measures the
good.
change, compares the bond price to the yield, to changes in the yield.
Very good. Yeah. So it is the approximate. Remember, it's not accurate. It's the approximate change in price for every 1% or 100 basis points change in yield. That's what modified duration tells us. Okay, so it's a sensitivity measure. You have to be able to explain it. So because it's a sensitivity measure, it can easily allow you to also, know the impact of any desired change in yield on the price of a bond. And obviously, from our formula, you have to get your Macaulay duration before you can get modified duration. Now, you must remember its limitations, okay? The main limitation of modified duration is what? What is the main limitation of modified duration?
Hi, Shay.
Hi, Chineye.
Yeah, so the main limitation is that it assumes a linear relationship. Meanwhile, it could be convex
Yeah.
in reality.
It's not even it could be convex, it is convex, okay?
Yeah.
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 So the relationship between bond price and yield is a convex relationship, but modified duration assumes that it is a linear relationship. So because of that, we normally have to perform convexity adjustment. So limitation is that it assumes linearity, but there is convexity. Okay. Next, Shay, what do I need to know under this section? Tell me, Shay, tell me, what's the next thing that I need to know? The next thing that you need to know, aside being able to explain and calculate, being able to explain the limitations of modified duration and calculate, modified and Macaulay duration, is actually there's something I wanted to mention. Good. Securitization. I gave you guys an article. I hope you all have access to it. Please, timekeeper, please remind me that at the end of the class, I say that I want to drop the article on securitization on the 2 groups for everybody. Okay.
Okay. All right.
Yes. So I don't know. It's been some time they tested, basic knowledge of securitization, the advantages and all of that, and credit enhancement. Okay, but please read that 2 or 3 page document that I prepared to explain it as easily as possible. Okay, so securitization and credit enhancement. Remember, the whole essence of securitization is often to, 1, make illiquid assets liquid, and 2, credit enhance or enhance the credit quality of an asset. Okay, make illiquid assets liquid, because through securitization you can borrow backed by some illiquid assets, and this borrowing can then be traded. This instrument that you have issued that is backed by this illiquid asset can be traded. So it makes illiquid assets liquid because you are able to generate cash flows from an otherwise illiquid asset. And 2 is typically securitization involves ring fencing those assets and sometimes even transferring them to a special purpose vehicle, special purpose entity for that purpose. Okay, so because that will be the only asset together with the corresponding liability tied to that asset in the books of that SPV, it makes that SPV and that your underlying asset to have a higher credit rating. And obviously you must remember the forms of credit enhancement. There's internal credit enhancement and there's external credit enhancement. All that you will see it in that short article. Okay? Yes, what else do I want you to know? I think it's a fair one for that page. I move on. Sources of finance and capital structure. This one, I've got nothing to say. I will not teach capital structure theories here. I will not teach what is debt finance, how is it different from equity finance, how is it different from private equity finance, how is it different from venture capital finance. I won't treat all of that here. Those are assumed knowledge at this level. If you can't remember it, please go back and do a quick review of that. As I've said, nobody will ask you directly, but in funding a merger and acquisition, they may ask you to evaluate a proposed financing method. In restructuring the capital of an organization, they may ask you to evaluate a proposed financing arrangement, e.g. a leveraged buyout or a leverage recapitalization or debt equity swap. Your ability to understand the intricacies of capital structure theories and the implication of these various sources of finance will go a long way in helping you. Okay, so that's pretty much 2 things: sources of finance, the financing method and issues, and then the capital structure theories. All right. So if you check your study notes as well, you will see the listing of those things there. Now, discount rate depends on the appraisal method being used. I think I've sorted this out already. What I wanted to say here is, remember, what did I say is the destination of our cash flows? What did I say is the destination of our cash flows? Just remind me. What's the destination of our cash flows? Duni, can you please drop your hand?
Net cash
Yeah,
flows.
Chineye, net cash flows. Yes, so net cash flows is the destination of our cash flows. Whether it's an international project or a local project, whether it's APV, MPV, IRR, MIRR, you always need to get to that destination, which is your net cash flows. And you arrive at your net cash flows by consolidating your operating cash flows, the tax implications, and the non-operating cash flows. And then what I've told you is if it is MPV, you would either discount using the current WACC if risk is not changing. That is, if it's not a change in business risk. As I've told you, changes in business risk is 3 steps. Changes in financial risk is 2 steps, okay? Or you use project-specific rates. And project-specific rate is the same thing as saying, what's that? Risk-adjusted rates, okay? So it's one of those two. If it's APV, APV requires that you discount net cash flows using KE on geared, and KE on geared is not the same thing as KE. The only moment when KE on geared is the same as KE is where the entity does not have debt at all in its capital structure and it does not intend to use debt to finance the project. Remember that KE by itself has beta equity as one of its components. And remember that beta equity tracks 2 risks, both business risk and financial risk. So the impact of debt finance would have already been reflected in your normal KE. But KE ungeared is what my cost of equity will be if I am not deploying debt at all. If I'm not deploying debt at all, okay? Now, question is, Shay, how do I get KE ungeared? KE ungeared is obtained using one of 2 methods. Method number 1 is CAPM. And what does the CAPM model say in terms of getting KE ungeared? That will be risk-free rates plus market return minus risk-free rates times beta assets. Asset beta, because asset beta only reflects what? Business risk. It does not reflect financial risk. The second method of getting KE is Modigliani and Miller proposition 2. And Modigliani and Miller proposition 2 says KE geared, the normal KE we'll know, is KE ungeared plus a premium, which is KE ungeared minus KD or risk-free rate, value of debt. Someone needs to be on mute. 1 minus T. Okay, so luckily that formula is in the formula sheet. But you've got to be careful in a computer-based exam. My advice is, you know, you may want to solve this thing outside and then put your final figures. You can create, because see, let me tell you, because I remember we did this when we did Fubuki in class, right? For a computer-based exam, you know, you will not have the luxury of writing out your workings, changing subject of the formula. In this formula, what you need is this KE ungeared. This KE ungeared. It's not the KE geared that you need. That means they would have given you the other components. So you must be comfortable with getting your KE on GET and inserting your answers on your spreadsheet. So if you have to do it on your pen and paper, you do it there, and then once you have your answer, you then insert it. Try to be accurate if you will not be using the spreadsheets, okay? But if you have to use your spreadsheet, then please make sure you get your formula exchange right. Now, I haven't discounted net cash flows using KE on GET. What does that give me? That gives me what we call base case MPV. Okay, then the next thing is now, if I decide to finance this project with debt, which is why one of the advantages of APV is that it helps you to understand separately the impact of financing on a project. The project is the investment itself. It generates its own cash flows. But how you finance that project may mark or make or mar that project. So the financing side cash flows, you then have to discount that using KD. I like to discount that using the cost of debt. Examiner also allows risk-free rates. Remember, examples of financing side cash flows are what? Tax benefits of interest on debt, subsidy benefits, okay. Sometimes they may also say issue costs. So all those things are even indicative of the fact that you should use APV. So these are financing side, the popular financing side cash flows. Then we have the break-even rates, which are IRR. So this one, interpolation, and MIRR. This one is PV of inflow divided by PV of outflow, and 1 plus R minus 1. If my formula is not clear here, refer to your notes so that you are aware of your MIR formula. And if it's already on the formula sheet, you've got no problem. Just be able to apply it. All right, I want to move on now. Any question? Toby, go ahead. What's your question?
Okay, thank you. Well done. My question is, could there also be a tax savings on issue cost?
Fantastic. Oh, yes, sure. There can be tax savings on issue cost. So first thing you need to remember is this. So since you've asked issue cost, let me deep dive into that a little bit. Number one, issue cost is usually on the gross finance raised. So the formula we apply here at Ivy League is pretty much to just say, what's the issue cost percentage? Issue cost percentage divided by 100 minus the issue cost percentage times the amount required for the project. Amounts required over 1. So if they say issue cost is 5% on the gross finance raised, you cannot apply for, and they say they need 100 million for the project. You cannot apply 5% on 100 million because they said issue cost is on the gross finance rate. So you will do 5 over 95 times 100 million. Now, your question is, can I get tax savings on that issue cost? If the examiner tells you that issue cost is tax deductible, then if your issue cost is, for example, $100,000, then you would have to now say 1 minus T, okay, because it is tax deductible. So you get it on an after-tax basis, and that's what you will put on your APV table. Usually in year 0, because issue cost is paid at the time of issuing that debt, which is on origination. Now, if the question is a complex question where tax is paid or claimed with 1 year delay, then it means the 100,000 will be under year 0. But the tax impact, let's say 30%, 30,000 will be under year 1. So you've got to be careful. The tax assumption in terms of when tax will be paid or received may influence what I've written down here. It may not be this way. You may have to put them under separate years if tax is paid with 1 year delay. Toby, did I answer your question?
Yeah. Thank you very much. And
Okay.
if tax is paid 1 year in delay, then it will be discounted back to year 0, right? Using the relevant
Very good.
discount.
It will be discounted. Yes, it will be discounted
Yeah.
back to year
Okay,
0
thank you.
using the cost. Yes. All right. I can see that I'm still on investment appraisal, and I planned to finish this my review latest by 11:30. So I must have been dreaming. Okay, I think at least I should round up investment appraisal before break. All right, so risk and uncertainty. Shay, if I'm in the exam hall, what do I need to know about risk? What can they possibly ask me, related to incorporating risk and uncertainty in a project? There are different ways risk and uncertainties can be incorporated into a project. The examiner can feel free to ask you any one of them, okay? But I'll tell you the more popular ones. So probabilities. Using probabilities, that's expected values. It has been tested before. It's not very popular, but it has been tested before. So this is where the examiner creates scenarios, and the examiner tells you revenue in year 1 is expected to be 5 million, subject to a probability of 20%. But if the government does this, revenue could grow from 5 million to 7 million in year 1, but that is subject to a probability of 30%. In another scenario, blah, 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 that's subjective. So once they give you different values with their probabilities attached, you would have to get a probability weighted average that you will then use for that line item on your, cash flow table. The other way to incorporate risk is the other one that we have discussed, project-specific rates. Project-specific rate. In a past question, they asked candidates that a non-executive director is concerned about the risks and uncertainties embedded in the project that management is saying that the entity should undertake. So the question was, what is happening here? Okay. What's this one? Airtel. Okay. I think I know why. The question was, sorry, is my script, okay, it's fine now. So the question was, discuss methods that management may consider to evaluate and assess the risks and uncertainty embedded in the project. So the examiner wanted candidate to reflect on this list and provide informed basis for using them to know what's their usefulness in assessing a project. Okay, so project-specific discount rate. Project-specific discount rate, as I've told you, whether it's your work that you are adjusting for differences in business risk or differences in financial risk of the project, is a way of incorporating risk. Okay, now the simple guy, payback period, is also a way of assessing the risk of a project, or if it is the discounted payback period. Now, can someone tell me, why is payback period a method? How is it useful in assessing the risk of a project? Short and sharp, please. How is payback period useful in assessing the risk of a project? Yes, go ahead.
Okay, so I would say a project that has shorter payback period, you get the cash flows quicker and you have less fixed compared to a project that has cash flows coming at the end of the project. So where you get your cash quicker, you can easily reinvest those cash flows in another project. But the project where you have to wait for a longer period of time, your cash is facing a risk of spending more time in a project where things may go south, basically.
Fantastic. That's really the essence, okay? A project that pays me back on time leaves me with lower uncertainties because, it does not tie my cash flows for a very long period of time. Thank you. And somewhat related to that is what we call project duration. That's also another method of incorporating risk. So you should be asking yourself, do I know how to calculate project duration? If you don't know how to do it, what should you do? Immediately after today's class, you put it as part of your to-do list. So I won't be able to go into the details of how to calculate project duration. But remember, project duration is the equivalent of Macaulay duration. It's the same process. The weighted average number of years it takes to obtain the cash inflows of a project. So unlike payback period is telling you how long it takes to recover your initial outlay. Project duration does not focus on the initial outlay. It focuses on the inflows, the entire inflows of the project. And that's what is bad about payback period. Payback period will ignore cash flows after the payback period. But project duration will consider all the cash flows of the project. So you must know the difference. Next, and this is a powerful one, very, very useful in real life, sensitivity analysis. Typically what happens here is that you've got a spreadsheet, you've done your analysis, and then you are saying, okay, if I change my tax rate and I increase it by 10%, what will be the impact on my APV or my MPV, on my net cash flows? If I change the unit price of what I'm selling from $10 per unit to $15 per unit, what will be the impact on my revenue and on my net cash flows and on my MPV? But the problem with sensitivity analysis is that it assumes that you can vary one variable while you keep all other variables constant. But life is not that simple. Basic economics tell us that there's a relationship between price and quantity demanded. If you increase the price, the quantity demanded may fall. If you increase your advertising budget, revenue may rise. So those relationships sometimes exist. And if they exist, sensitivity analysis may not really reflect clearly the impact of multiple variables changing simultaneously, the impact it has on your MPV. Herein lies the importance of Monte Carlo simulation, because with simulation, you can change multiple variables at the same time to see the impact on the MPV, and you can actually see at what point will my MPV start going negative, such that you can also test the variables that your MPV is most sensitive to, and the combination of variables that would give you negative MPV. Another way you can incorporate risk and uncertainty is project value at risk. So you should ask yourself, do I know what value at risk means? If the examiner asks me to calculate 90% VAR, of a project for 6 months. Can I manipulate the numbers to get it? Do I know how to even get the score for 90% VAR? You know, these are critical questions you should ask. Can I interpret the results? Value at risk tells you the maximum loss over a given period of time at a given confidence level. Very useful tool in financial analysis or risk analysis. The maximum loss. So I'm putting my money in a project. What is my maximum loss that I can make over a given period of time, whether it's 1 year, 4 years, 3 months, whatever it is, at a given confidence level or level of confidence. So you've also got to know how to convert your annual standard deviation to semi-annual standard deviation. If you have an annual standard deviation of, let's say, 5%, you know that semi-annual standard deviation will be 5 divided by root 2, not divided by 2. Or if your standard deviation is 10% annual and you want 2-year standard deviation, 2-year standard deviation, if this is 1 year, 2-year standard deviation will be what? 10% times root 2. It is not a linear parameter that you will be dividing it and multiplying it just by the number of periods. So please, as I said, go back if you have to go back on that, okay? Sorry, let me just take care of something so that I don't lose this information.
So Shay, while you are taking care, the time is up. So, and based on your comments that you want to round up the session by 11:30, so I want to assume the break will be starting by 11:30. So 11:15,
Okay,
we just
thank
remind
you
you.
very much. Thank you. So I've got 15 minutes more. Thank you, timekeeper. All right. So next
Sorry,
thing,
Shay.
option
Sorry, Shay.
pricing.
Just one.
Yes, go
Sorry,
ahead.
Shay.
Go ahead.
For this VAR, why do we need to do the square root?
You have asked me
Because
a
I also
hard
noticed
thing.
that. No, because I also noticed that that's also a formula that is applicable in option.
It is
In D1.
applicable in
Why
option
do we need to?
pricing. It is applicable in option pricing as well because you are using standard deviation. Remember, standard deviation is your measure of volatility.
Yes, I do.
Yes. So why we have to, apply square root of this, square root of that, it is a mathematical derivation process that gives us that theory. I don't want to go into that details. Do you understand? Just know it as a rule, okay? That your standard deviation for an annual period is what you typically need because the rates that you are using are annual rates. So if, however, you want to compute something for 6 months or for 3 months or for 3 years, as you are scaling up or scaling down your rate, you also have to scale up or scale down your annual standard deviation. While I may scale up my rate by multiplying it or dividing it by the absolute amount, I can't do the same thing for standard deviation for mathematical purposes that I don't want to go into now.
Okay, thank you.
Option pricing. Now, my plan when I get to this point is actually not to do anything, okay, but to remind you that there's a free video on option pricing. And if you've joined us free of charge, if you've joined us for this free revision just today, I will send the option pricing video to you after the class, just remind me on your group, which you can watch free of charge, which explains to you my understanding of option pricing for your syllabus. But I will say a few things. Number one, remember that we are talking about options. So options, you must understand 5 parameters of option pricing. 5 parameters of option pricing. Okay, and obviously I know that you know them. I will not bother asking you. What are they? The value of the underlying item, which we call PA, value of the exercise price, which we call PE, then the risk-free rate, the time to maturity of the option, and the standard deviation, which I can call S. Okay, so remember that the underlying price, the exercise price, the risk-free rate, the time, the standard deviation, they are all inputs. And being inputs, they will have different impact on the value of options. For example, underlying price has a direct relationship with the value of a call option. But exercise price has an indirect relation, an inverse relationship. But exercise price has a direct relationship with the value of a put, not call, while underlying price has an inverse relationship with the value of a put. Can somebody remind me, what is the relationship between time to maturity and the value of a put option? Yes.
Direct relationship.
Direct
Exactly. There's a
relationship.
direct relationship.
Okay, what of time versus call option? If I had said call option, what is it?
Is the same thing because
Direct.
an
The
option can
same,
never have a
yes,
negative value.
exactly. So these two, whether it is call or whether it is put, they have a direct relationship with the value of a call option and put option. The idea and the sense being, the longer the time to maturity and the higher the volatility of the underlying item. Volatility means the extent to which the prices go up and down, the more probable it is that that option will end up being in the money. But what if the option ends up being out of the money? Then I will not suffer anything because it's an option. I can walk away. But if it is in the money, then I make a gain. So time and standard deviation always have a direct relationship with the value of a call and put option. And remember that these two, the sensitivity of call and put option to these two is called theta and vega. Theta and vega. So you should ask yourself, for example, do I know what theta means? Do I know what vega means? Do I know what it measures? Do I know what rho means? Do I know what delta and gamma means? If you don't, you still have time to go back to your study notes. You still have time to ask questions. And if you are on the revision group, okay, the revision group, you can ask questions there. All the tutors are there ready to answer questions that you may have. Please, you can ask questions. Okay? Yes, so once you know the 5 parameter, very important. Bumi, go ahead, ask your question. Your voice is very faint. I can't hear you.
Can you hear me now?
Still very faint, but yeah, I think I can manage this one.
Okay, so my question is on the issue of the standard deviation that you talked about, where you have to you know, if it's semi-annual or annual.
Yeah.
So, for
Yeah.
example, you're giving a BSOP question and they're saying that the time to maybe exercise one option is like 3 months. So, you know, when you're calculating your time should be in years. So, in that manner, you would do 3 divided by 12 to get your time in years. Now, do you now also do the same thing to your standard deviation, or you use the full figure?
Good question. Now, don't touch your standard deviation, and I'll tell you why. Remember that um, in your call option formula, you have D1 and D2. D1, the formula is something like this, PA over PE, you know, PA over PE, natural logarithm of that minus plus R plus 0.5 ST ahead. Now watch this denominator. The denominator says what? Standard deviation root T. Can you see that this formula already does what I was saying? So your standard deviation here is an annual standard deviation. That 3 over 12 that you said you would have done, which will give you 0 point whatever it is what you will put in this root. So you can see that that root already adjusts my standard deviation. Does it make sense? Did I answer your question?
Yes, thank you.
All right. Shina, I saw your hand before, but it's down again. So maybe you don't have a question again. All right. So now let's move on. What's the next thing I want you to know under option pricing? Yes, you must know when we value options. So option valuation. Remember that the whole essence of this whole thing is to remember that we value options at 2 points, at maturity and what? Prior to maturity. Prior to maturity. No examiner will give you a question for valuation of an option at maturity. The only place where they will give you that kind of question is under interest rate, is under risk management, option pricing. Options hedging, where you compare PA with PE, exercise price with underlying price, to know whether an option will be exercised or not at maturity. But under a full option pricing question, you will typically have to value an option prior to its maturity. Because why? Because why? Because why? Hey, because why? Because the value of an option at maturity is called the intrinsic value. Intrinsic value. And the intrinsic value of an option is just merely you comparing PA versus PE, exercise price compared to the underlying price. So depending on whether it's a call or a put option, you would exercise. But prior to maturity, the value of an option is the intrinsic value plus time value. And the well-known model that tells us how to value an option prior to maturity, which considers both intrinsic value and option and time value, is the Black-Scholes option pricing model. And as you know, time value, this component called time value, are these 3 things here that you have here. Okay, so are the 3 things: R, T, and what? S. Intrinsic value is PA and what? PE. Don't forget that. There are some questions on option pricing that the examiner have given in the past that has more discursive element than calculation. They want to know, do you even understand what time value means? Do you know that what time value actually means is this? This is what time value means. Time value is saying, prior to the maturity of an option, a call option, for example, remember, when is a call option exercised? A call option is exercised when PA is greater than PE. That is, the underlying price is greater than the exercise price. That's when a call option is exercised. But an option that is prior to maturity, PA may be 10, exercise price may be 12, which means this option should have no value. But because of time value, the value of this option may be positive instead of being 0. So time value may make an out of the money option in the money. That's why we must consider time value for options prior to what? Maturity. Now, Shay, what do I need to know about BSOP? Very simple. Know how to apply it and to know the assumptions and limitations. If they wake you up from your dream in a dream, meaning you are still dreaming, you should be able to state categorically the assumptions and limitations of the Black-Scholes option pricing model. For example, remember, it is for European style options. Your syllabus expects you to know that you cannot use it to value American style options, which are options that can be exercised anytime prior to maturity. The next thing you need to know is how to value a put, valuation of put option using put call parity. And you remember that put call parity is part of your formula sheet formulas. Yes, it's one of the formulas you will see on your formula sheets. It helps you to value a put option. Then, finally, the last thing is to know how to value real options. Okay, so remember that real options are options that are embedded in tangible projects. So an examiner may give you a full investment appraisal question and expect you to reflect on the value of option to abandon, which is a put option, option to expand, which is a call option, so you treat it as a call option, option to delay, which is also a call option, so you treat it as a call option, and then option to redeploy, which is a put option. Okay. So please, what do I need to know about these things? I need to know what will represent PA, PE, R, C, and S under each of these scenarios. That is the main thing. Some candidates are very good. I've seen the timekeepers and some candidates are very good at what? Calculating Black-Scholes, but not very good at getting their inputs right. So you have to know, if I'm dealing with an option to exit a project, what should my PE be? What should my PA be? What should my R and TS be? Okay, so you must know those things. All right, I think it's a good time to take 15 minutes. Obviously, I'm behind my plan, but the other ones are not as deep as investment appraisal. Okay, so I've just scratched the surface of investment appraisal for you. Do you have any question? Any question?
Yes, Shay, I have a question.
Yes, what's the question?
Yeah, I noticed that when using the CBE, and you try to use the formula to arrive at your figure, and most of the time when you are linking all the formulas together, your answers, most though not material really, have some way of differing from the solution, where maybe the actual figure or maybe the figure being used is an approximation. So would that have any impact?
No, that won't have any impact. You're fine. You're covered.
Okay, thank you.
Any other question? No question. So we come back by 11:45. Thank you. 11:40 in 15 minutes time. Let's just put it that way.